Hey, what's going on, everybody? Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, an aspiring investor, maybe you're an industry insider, or maybe you just like the idea of creating passive income and generational wealth by investing into multifamily apartments or real estate. Well, if any of that's the case, you are in the exact spot that you should be, because on the Gray Report, we like to dig deep into what is going on in the market today, specifically focusing on the multifamily market. But we're really looking at all the factors, kind of macro and micro, that affect the multifamily industry, real estate, and the economy. So again, a lot of stuff going on this week, but let's just get into it. All right, another great episode of the Gray Report. But first, a quick message from our sponsor. This episode of the Gray Report is sponsored by GrayReport.com, the leading multifamily intelligence aggregator, covering, again, all the great stuff that we talk about in the Gray Report, but it's done 24/7. So hop on over to GrayReport.com so you can stay up to date with all of the new information, data, research reports, podcasts, videos, articles, opinions, original content, again, all centered around the multifamily industry, real estate, and the economy in that order. So go on, check it out, GrayReport.com. All right, so now let's just bring in, like we do every week, Matt Bosnagel. He's the Director of Communications and Marketing here at Gray Capital. Matt, it's been an interesting week. How have it been this week?
Yeah, a lot of things seem to point to things in the future this week. Inflation is a fact of life. Housing affordability is in the spotlight. Housing supply really has the White House paying attention. A lot of signs right now of things that will come to fruition, perhaps dramatically so, in the next several months. So it's exciting, but you have to really have that long-term mindset to really see, to kind of interpret what we're seeing today.
Do it. Yeah, I think a lot of people are trying to figure out where we are, where we're going. I was asking how you were doing, Matt, but I'm glad that you're focused on the task at hand.
Exactly. I've got a job.
Good stuff. Okay, so let's just get straight into the report. And again, this report is delivered to your inbox every Thursday morning at 8:30. You can sign up for the Gray Report newsletter by going over to graycapitalllc.com/newsletter. So if you're not signed up to receive it, go ahead and do that right now. So for just the first article that we're going to talk about, starting with kind of where we left off last week. We were getting ready to watch Jerome Powell make his kind of statement after the Jackson Hole kind of summit conference that they do. Now, it was done virtually this year. This is a lot of the Federal Reserve governors, interested parties getting together, talking about the economy, talking about central banks and monetary policy, things that they talk about. Jerome Powell and the Federal Reserve, they're obviously so important in the direction of where the Fed is going, and really what are they going to do with tapering, the bond buying, and moving interest rates has been a key question for anyone involved in anything related to money. And it was no real big news, Matt, it sounded like.
Yeah, I am waiting for someone from the rhetoric and composition academic community to do a study on Jerome Powell, because his words are almost precisely engineered to not rock the boat or suggest anything dramatic. So really nothing huge in this communication. Even so, there's a lot of money riding on the specific words that Jerome Powell says. So I think that has created this situation where they don't want to leave anything up to chance, surprise, or interpretation. And that's kind of what you saw in the last week.
Yeah, well, so luckily, Jerome Powell, he is an attorney by trade, not an economist. And so I think that probably has a lot that goes into what you're talking about, how the words are chosen very carefully. And they have for past Fed chairs, but even more now today, because that people know that if we see a rise in interest rates, that's going to completely change the fundamentals of the economy. Really, what I got in, and I watched his press conference, I think on Saturday night, and what I took away from it is that there's really kind of two pieces that folks are talking about, and are the kind of the two methods that we're paying attention to. One is the bond buying, quantitative easing. The Fed's buying was 100 $40 billion worth of bonds every single month between treasuries and mortgage-backed securities. And then there's the interest rates, and keeping interest rates essentially at zero. It was said pretty clear, interest rates are not being changed. That is not in the near or medium term. What is in the near or medium term, potentially, maybe by the end of the year, is slowing down the buybacks or the purchasing of bonds. And so that might slow down maybe by the end of the year, but that's not, they're going to turn it off. It's really, they're just going to slow it down and just kind of just ease that purchasing off. But really, it's not, they don't want to do it at the expense of anything. They really want to push past 2% inflation, which we're already past. They want to see as high of employment as possible. And, there's concern that it can kind of get away from them. But the view is that the kind of the meta demographic and technological forces and just the kind of the trajectory of a mature, developed economy is not super high growth or high inflation. And we're going to revert back to that at some point, and taking the foot off the gas poses more risk than running a little bit hotter for longer. And we really have to be watching what the Fed is going to be doing. And what they're saying. I mean, that is key. If we know the Fed's playbook, we can really take advantage of it. And really, we're catching the wind in our sails that the kind of the Fed is blowing out there. And as much as go ahead, Matt.
Yeah, and it's not like the Fed says nothing in these announcements. But what they do is they will tell you long ahead of time. It's just nothing surprising. It's not like they haven't changed course or reacted to certain events, but all of these reactions are a little bit softened, and you can kind of see them instead of like a dramatic surprise.
Yeah, I think that's key. The markets don't like surprises. So again, just mentioning inflation, but it's related to housing. And Matt and I were just talking before this of, sometimes we talk about inflation is driving home prices, but really it's home prices and rentals. They're driving inflation. Other factors, other prices increase, and it becomes a cyclical loop. And really, it's psychology that really drives inflation more than anything. And that's what the Fed is worried about. That's what caused really inflation in kind of the mid 70s and 80s. It was the perception that we are going to see higher prices leads to different consumer behavior, and that's what the Fed is concerned about. And so you have to wonder, even if inflation was not going to be transitory, would they even say that because of the psychology? If the Fed came out and said we're going to have long-term inflation, that goes directly to the psychology of consumers and business owners and how they're going to react and how they're going to spend their money. If your money is going to be worth less tomorrow, you're more likely to spend it today. That higher velocity leads to more inflation. So that's that inflationary spiral that they're concerned about. So you kind of really have to read between the lines, and but they're obviously not too concerned, because then they would raise rates and just pump the brakes, but that could just literally wreck the economy. So they're walking a very fine line. So Matt, what about this? Two more factors that have popped up at the Fed.
You noted the housing prices, housing affordability crisis is really coming into the spotlight, specifically housing supply. And you pulled out a paragraph, I think, that really helps to characterize a lot of the news that we ran into this week. And I'm just going to read it here. It says that these economists wrote that rising housing prices are usually a leading indicator for rents, which account for most of the shelter costs in the CPI calculations. The correlation, they said, hits with about an 18-month lag time, meaning that rising housing costs now promise heavier rent burdens in the years to come. A year and a half is a bit of a lag, but it does indicate that the stuff that we're seeing today is going to have an effect in the future. We're just seeing the very start of it. As much of upheaval has happened in the last year, there are signs of like another wave is going to crest because of the consequences of all of these shortages and just the complicated nature of the economy.
I think some things it's like it's watching Well, I was going to say, like a car wreck or a train wreck and slow motion, but certain things that are happening now, we can see. Now, we don't know anything for certain, but we know higher prices are going to lead to higher rents. And specifically talking to multifamily, I mean,
Yeah.
we see it because, when we're looking at projects and if market rents have been moved to a certain amount, and we're looking at projects where, the lease rent, the average lease rent, that the average rent that someone at the property is actually paying, maybe you call it $800, but the new market rent that a new resident, a new tenant is paying, maybe $1,000. And so
Yeah.
we know that we're not going to lower our rents back down to, $800, because why would you? Someone's willing to pay $1,000. You may move those current residents up to that $1,000, move them up to market, not immediately, but over time. And so 18 months, you would start to have seen a lot of that absorption, because usually there's about a 50% turnover rate. Some residents stay longer, but over a 2-year period or a year and a half period, you're gonna have a decent amount of turnover. And you're gonna be raising rents on those existing residents, but maybe at a slower rate, so you don't wanna just kick everybody out, especially if they're a good resident. So, I mean, I'm just looking at the models that we're doing. That's kind of similar to our projections. We're seeing decent amount of increases over the next couple of years, because we've seen just the market rents pop up, 10, 20% in some cases. So it's happening right now. And we know that will continue to happen over the next couple of years. And this all relates to, we are also talking about hearing people say that this market is crazy and makes no sense whatsoever. And it seems crazy from how fast it's moving. It does not seem crazy, or it doesn't seem crazy in a sense that the prices can't be justified. Because I now, you see here some of the prices, and they're really paying up for the future. But if you're willing to wait a year or two, rents are rising now. They're going to be higher in 18 months, 24 months, 36 months.
Yeah.
Are you willing to, wait that year, 2-year period while rents kind of move up there? Because we're seeing this top line, revenue growth. We're not just seeing asset price inflation with no actual income growth. I mean, that would be a sure sign of a bubble, but we're seeing it because of actual revenue. It's like in the stock market, our PE, the prices are going up, but what's the PE ratio? What's the actual price per earnings? And it's not considered people don't call it stock expensive because of whatever price it is. People call it expensive relative to what the earnings are. And if those earnings are, if it's a lower PE ratio, it doesn't matter what the price of the stock is. It's based on what the actual earnings are. And so in this case, we're talking about real estate, the earnings, the revenue is increasing, which is driving the prices. And then that future anticipation of that revenue, because investors are paying for that future income stream. People are paying up as they know that income stream is going to be growing significantly. And so that's where cap rates are crazy low, it seems like. But you're just forecasting, you're looking at your purchase price cap rate, you're going in cap rate, but then you're looking at your in place, cost on cap or yield on cost, or your kind of operating cap rate or whatever you want to call it, really yield on cost. It's going up, and you can make sense of it. So is the market crazy? Sure, it's wild because people are just running around trying to get deals. But can I make sense of it, even from a relatively conservative point of view? Yes, and I think the market is making sense of it vis-a-vis people going out there and taking advantage of these opportunities and buying.
Yeah, and that seems to be the case. I bet that there's definitely more than a handful of people who just had to have a deal, had to have somewhere to put their capital this year. And it's like, oh, okay, I'll take it at a higher price. And suddenly it starts to make sense. And it is crazy, but justifiably so. It seems
and that's a good point too, because there is this, like, I've got money, what do I do with it? I've got to put it somewhere. Yeah. And I think that is a factor in driving prices, but might as well put it somewhere that's actually going to get some yield and a return. And things will get to a point where prices don't make sense. And they say the only cure for high prices is really high prices. So we'll get to a point where the returns don't make sense. But I'm just saying, sitting here, the people that are in the trenches day by day, we are making sense of it, at least to some degree. Not that there are a lot of bad deals out there. And we've seen a lot of deals that don't make sense. But it's not the blanket statement, the market's crazy, the market doesn't make sense. I think if you really took time to understand the market, it would make a little bit more sense. Yeah. Okay, Matt, eviction moratorium. What happens next after the Supreme Court ruling on evictions? Eviction moratorium is tossed out for good.
That's the big question. We haven't seen reports of a wave of newly evicted individuals, and to be fair, there hasn't been a lot of time since the end of the eviction moratorium, so that could be in the offing, but I'm not really certain about that. This report suggests that we're not going to see that huge wave that others are predicting. And here I will note a huge obstacle in the legal system. It's going to take some time for courts to process any evictions. And as we have said before, and this report notes, landlords are not going to want to evict people automatically. That gives away the chance that they're going to get rent. And so they could set up a payment plan or other arrangements. Really, eviction is the last resort of a number of different options that I don't think that landlords want to jump to eviction automatically. And I don't think it makes sense to, and psychologically, they don't want to kick people out of their houses either. So I hope and expect that there is not going to be this sudden surge of people that are out on the street.
Yeah, I think it's a good point that it takes some time to work through the system, and in many cases, there's already a backlog at the courts themselves. Yeah. But also a good point. Owners, they don't want to kick people out, especially if there's like rental assistance out there, and that's where I'm hearing from owners, us included. In it's that money that is rental assistance has been slow to get out, but it is getting out. We have a handful of residents at a handful of properties that are all successfully getting rental assistance if you actually try. So management companies are working with those residents, because if you're making your best efforts and the money's there, it's all good. Who wants someone to leave? If the bills are getting paid, you don't care who's really paying it. But at the same time, we've evicted a couple of people the past couple of weeks, but it wasn't because they weren't paying their rent. It's because they pulled a gun out on somebody, and it's like, all right, you got to go. I'm sorry. Yeah. It's a health and safety thing. And we have also evicted a handful of people for non-payment, but it's because they never paid. They can pay. They didn't file a CDC waiver. They didn't make any efforts, or they probably could have paid and they just were refusing to pay. And so it's like, sorry, but we're filing just regular course of business. And since the eviction moratorium ended, it was like there's no really change in what we do. So I think that's a lot to do about nothing. You saw videos and articles immediately when the Supreme Court decision came out, being like, the tsunami is here. We're going to see tomorrow people just being put on the street. As we have been saying for just about a year now, that's not happening. It's not going to happen.
And we'll note later in the report, the White House even is kind of viewing this a little bit differently than would be characterized by a ban on evictions. The current kind of housing crisis that we're facing. So. Yep. No,
that's a good. Let's get to that in just a second. I think this will segue maybe into that. But an interesting article that got some decent mainstream media coverage is a CBS story. Landlord faces homelessness as tenants fall behind on rent during eviction ban. Now, Matt, this is obviously a personal story. It's an anecdote, but I think it symbolizes that there's no real free lunch, and you can't just throw a wrench in the gear of this housing system that we have, albeit not perfect, and not have consequences. You can't just erase pain. And so basically the story is this: it's just a small time landlord. I think she has 3 or 4 rental properties, and in New York, which. That's why we don't buy properties in New York. She's not in New York City, just upstate New York. And she hasn't received any rental she hasn't received rent from any of her tenants for the past year. She lost her job. She had to move out of her house. She was trying to get one of her residents who hadn't been paying to move out. I guess they had been paying, but then she asked them to move out. Then they stopped paying because she wanted to move in to one of her units that she owned. They won't move out. So she doesn't have anywhere. She's sleeping in her car with her daughter right now, homeless essentially, because she's owed over $30,000 in back rent and nobody will pay. It's sad. And again, there are plenty of stories of bad landlords kicking people out for no good reason. So that's not to say poor landlords everywhere. I would also say most of the landlords that are having issues are more of your part-time landlords, or I would say non-professional landlords, smaller time, who don't have maybe all the systems in place. Maybe they have a very personal relationship with their residents and they haven't asked them to pay or something. But it's an example of this whole eviction moratorium was just a bad idea from the beginning, as we've been saying for quite some time. But let's jump ahead, Matt, to this White House thing. Alleviating supply constraints in the housing market. So this came out today. We're doing this on September 1st. The report's coming out tomorrow on Thursday. Matt, I'm happy to go into this, or would you like to take it off?
Just how it kind of frames it. I think that the analysis from this White House Council of Economic Advisors is worth noting because it indicates that how they're viewing the problem and potentially how they plan on addressing it. Right in the title, they acknowledge it that this housing affordability crisis is a crisis of supply. They don't talk about an eviction crisis or a rental crisis or housing price crisis. They're going at the level of supply. And I think that that suggests that they will be addressing this problem at that level, which is a lot easier to swallow than kind of more restrictive things, treating the symptom instead of the problem. There is a lot of articles that will include this this week about slowing housing construction and low housing supply. We're building more houses. We're building more housing supply this year than we did in the past 2 years. Still not enough. There's still a lot of demand, and it's not going. These problems are not going away anytime soon, like I kind of mentioned before. So it's encouraging that the White House is noting these supply problems. It just remains to be seen how much intervention is going to solve them.
Yeah, I think that's a couple good points. Identifying that it's a supply issue, not necessarily that rent control is the solution, and really tackling the source of the problem, not symptoms, which would be higher prices. And so I think this graph to me was the most illustrative. It's supply shortages in the housing market. This basically shows housing starts as a share of population, and then the 10-year moving average. You can see back in the 70s, we were over 1%. I mean, we peaked at 1.2%. So we were 1.2% of the population is how many housing starts there were. Now that albeit that's a lot, but then we've been on a decline. Now our population growth rate has been slowly declining as well. Our population though has been growing, and so you can see. I mean, and we've talked about this so many times, Matt, but we got to the crisis, the housing crisis. 2008, 2000, they're really showing it starting in 2005, 2006, but really kind of bottoming out in 2009 and never recovering. We haven't gotten back to anywhere close to the pre-financial crisis great financial crisis, rate, even not even close to it. We're basically half.
Yeah,
not even half there. I'm going to go back. Yeah, so basically we're at 1999 levels, which was still a low. Really you have to go back to almost 95. So seriously undersupplied. And some of the solutions that they mentioned, they're talking about more funding for LIHTC. They're trying to get rid of some zoning restrictions and really kind of clear the way for development, which is what is needed and what needs to do. I mean, clearing up as many regulations as possible.
Yeah,
I think would help. And so again, this goes to show though, and just like we're monitoring the Fed of what's the Fed doing, understanding the Fed's playbook. If we understand also what the federal government and the government is incentivizing, again, it's all this notion of flowing downstream and catching the wind of just where everything else is going. Where are the incentives? Where's the money flowing? And taking advantage of that, and and capitalizing on it. It's obviously a need. It's a need that society needs. That the government's saying we need this. We can't figure this out. We need the private industry to come in and do this.
Yeah.
And then they mentioned not only we need to build new housing, we need to renovate and rehabilitate housing that exists. We need single family homes. We need multifamily homes. And so this is, the alarm bells are going off. We need more housing, and that's why we need more investment in housing. And one thing that I was happy to see on this, and it's mostly just because I've gotten asked about it a lot, is the whole idea of national rent control, or as just like rent control being, necessary, or like, that's the next step. It's not mentioned. It's not mentioned like once. And this is not a short, it's not in like the realm of, hey, this, rent control might help in the short term. No, it's not a part of the solution whatsoever, which it's not. And I'm just glad that it's not thrown in there as a token piece, even if it's for cheap political points.
Exactly, because this is a communication above all from the White House. And so, this is not necessarily meant to be like a policy document or a legal document, as much as this is showing what the White House Council of Economic Advisors is thinking about, and their community. They don't want to say rent control because I think that they know that will be perceived wrongly. It seems like it would be a political problem, but.
Well, and like we were saying also before this, the only place that rent control works, when I don't say it actually works, like it can get passed, is when it's a hyper local issue and you have a local population that's basically saying the rents are too high. And the rents are usually too high because the local population has put in restrictive zoning laws and regulations that did not allow an appropriate amount of housing units to be built. Now they're mad that there's a low supply, prices go up, and they're saying, okay, now you need to get into the game of price fixing and fix the pricing of housing. Luckily, even the Democrats, they're smart enough with their economists to say, it ain't gonna work. It's not gonna work. Rent control is not what we need. Yeah. It's not a solution. It is a non-solution even for the symptom. It appears to address the symptom, not even the problem. It doesn't even fix that.
Yeah, I think it's particularly notable too. Like, we're on the heels of the eviction moratorium. They were willing to extend it, but they weren't really willing to include that kind of policy decision inside this, even really suggest it inside this. No like control of the rent, no control over evictions. It's more about opening things up and trying to increase the supply.
Yeah, no, that's a good point. Okay, so Matt, do you want to mention the Case-Shiller index? Home prices are up. Home prices are up. But is that news?
It's not much news. But again, it does put some hard numbers on things. This like an inexorable trend really is it seems like it's not going anywhere, and we've seen signs again on the supply side that suggests that things aren't going anywhere in terms of housing affordability. 18.6 is a big number. And I do want to note that it is a housing crisis, but it's not like a decade ago. There's less of a threat to the financial system or risk of collapse. Prices are just going to keep going up because we're not as vulnerable to things like subprime mortgages or anything like that. And at this point, there's nothing concrete that would suggest really even a measurable correction to the tight housing supply. There may be a little bit of a dip, but it doesn't seem like there's really any reason for housing prices to go down dramatically.
Yeah, unless we're totally reading the Fed wrong and interest rates rise and no one can afford that's such a kind of a fringe possibility. But I do find it interesting. It's like if there's a bubble, if there's a bubble, everything's in a bubble, and because you see excess money, people spending money on things. You've got digital NFTs, cryptocurrencies, people buying a second house, watches, cars, whatever, because people got extra money. They need to put it somewhere. Why don't you put that in multifamily apartments? That would probably be the place to do it. That's what we're doing. So, okay, Berkadia report. And again, Matt, all these great reports, everybody wants to know how you do it. And we're not going to give away your secrets, but sign up for the Gray Report newsletter. Where can you do that? Where can you do that, man?
That's Gray Capital LLC.com/newsletter. You'll get it right in your inbox every Thursday morning.
I don't know how else I would get all these awesome reports. So anyway, not to detract, Matt, Berkadia, and we're going to be having some of the Berkadia guys on next week, which we're really excited about. But so they're talking about demand. Demand hits a record in second quarter nationally. Matt, what are some highlights?
Yeah, demand was nearly 500,000 units in the second quarter. That was doing well, and then that's the quarter before was also doing well. It just continues to do amazingly. And then you noted earlier that there are some markets that are doing that don't have that continual ramping up of demand, and that seems to be more of a function of their resilience through the pandemic. There's not as much pent up demand, but it's still in terms of absolute demand, there's hardly a market that isn't going up right now. So this is all of a piece, and I do want to note that again, it's built on this shortage of supply. I think yes, the demand is there, but the unspoken thing in this one, at least, is because it deals with absorption and not really housing starts, is that there's just fewer to choose from, and so the housing that does remain is getting all that demand.
Yeah. I've, again, this is an anecdote, but again, we're just seeing so many of our properties in our portfolio, and then properties that we're looking at to potentially purchase, and just properties that we're aware of and that we're tracking. Occupancy is at record levels across the board, and that is, a function of demand. It was interesting, that second piece about some, a lot of Midwestern kind of low supply markets, that basically saying few vacancies are holding back the demand. And I'd be curious, I'd be curious to, I guess, ask the Berkadia guys, and I don't think they are the ones who put this report out, but how is, I guess we're seeing less vacancy, higher occupancy, but how does that translate to lower demand? Because I'm just curious how that's being calculated, because they're showing that demand is in Indianapolis down 25%, it's down 50% in Cincinnati, Sacramento, it's down 38%, and these are all markets that are seeing incredible amount of rent growth and occupancy. And so I'm just curious of how they're actually measuring that demand. Not saying that it's not accurate, I believe it is, and in their argument is saying that a lot of these markets performed exceptionally well and really outperformed a lot of other markets during the pandemic, and so they didn't have, I guess, this excess demand that was pent up because there just weren't as many lockdowns. But because I guess Sacramento really strikes me, because Sacramento's seen so much, I would say, demand, but I guess maybe not. Okay, sorry, Matt, finish what you were going to say.
Yeah, I just wanted to note. I wanted to return to a few supply articles once we're finished with the discussion here, because I didn't want to leave out some comment on, because that really helps you to kind of see the future in a way that this demand, it just seems like it's if you look at that trend line, it's high, it's gonna stay there, and the only thing that really can treat it and address it is getting new houses on the market. Yeah, no,
I think that's a good, good point. So let's look at this report from the multifamily construction sentiment survey put out by the National Association of Home Builders. This essentially saying that the sentiment about current conditions to develop new apartments it's at 48 from a scale from 0 to 100. So slightly less confident than confident to build new construction. A lot of this has to do with supply constraints, labor, and really on the building side. But then the second piece of this survey is an occupancy survey, and kind of where they see occupancy moving. And this isn't where they think you see occupancy is at, what the occupancy rate is. It's just do they think things are going to be more occupied than less, is the way I understand it. And anything over a 51 means things are going to be more occupied. Vacancy is going to be going down. Below 50, it's the occupancy is going to be going down. And so, but right now we're registering at 70, which is the highest reading since the inception of the series. So they are, which makes sense. So they're saying, I don't feel that hot about development. I don't know if I can get the people to build. I don't know if the materials, what it's going to cost. But they're saying, but I see occupancy just tightening up because we're not going to be building as much.
Yeah, which says that they're not building things because people don't want it. They're not building because there are these discrete, transient, problems that are affecting building. And this other this RealPage report kind of comments on that as well, at how again, these are lagging indicators, just like the 18 months that it may take for higher housing prices to translate into higher rents. These labor issues and commodity issues are things that we're going to see down the lines or down the line for really years to come. We're likely to build more supply this year than we did in 2020 or 2019. That still means there's a rough road ahead. We, again, like I talked about the labor and commodity problems. It's a good example here. The sentiment from builders really reflects the current problems. And then maybe in the future, we're kind of starting to see housing starts. So the sentiment is not as confident. Now that's translated into really action, and these housing starts are kind of lower a little bit too. The RealPage report notes that housing permits are actually up, which may mean that starts could come up later. But according to the National Association of Housing Builders, it doesn't seem as likely as really RealPage has it.
Well, now, but is RealPage is that they're talking about single family home permits, whereas the National Association of Home Builders was multifamily?
Yeah, you know what? That's correct. I think that they're talking about both here.
Okay. I mean, it would make sense.
Total residential building permits. So multifamily and single family permits are, yeah. It's
interesting. Yep.
It is interesting. And this is just an example of these signs of things that are going to come, that are coming to come in the future. And really what's notable is what's not notable, in that we're not seeing a huge surge of multifamily supply coming online. So this crunch that we're experiencing right now is going to be present for, at least 6 months, I think.
And I think that's that's critical, because it's not what's happening now. It's what's going to happen over the next couple of years. And like when I look at a market where average occupancy is 98%, but there's nothing in the pipeline to be delivered for another 30 years. What I mean, like super simple economics, Econ 101 says that those rental prices should go up. I mean, it's pretty basic. And so again, as buyers, it's like, what do we think is going to happen? And how confident are you on rent increases? Well, rents they're not going down. And it's relatively straightforward. You have to ask yourself, what are we missing? What's the the black swans that are out there? But sometimes you have to have an appropriate view of the landscape, and once things are clear, you got to make the decision.
And that's what it seems like. It's not like an asteroid's going to hit, but it does seem like we're seeing this huge problem that's going to happen, in the next year or so, and it doesn't have that huge punch of rents going up by hundreds of dollars in 1 month, but nevertheless, it is there, and it is worth paying attention to, because we are going to see a dramatic difference in the way that housing is today versus next year.
Yeah.
So.
Matt, have you seen anything, and I don't mean to put you on the spot, but have you seen anything recently on wage growth? And I know wages have been growing, but have you seen anything recently on wage growth in US?
Nothing dramatic, nothing huge. I don't think that, I think that it would have been noted especially in like that inflation article as a large factor. I don't have my,
Oh, I know. Yeah. Well, because like rents can rise if wages are rising, people can pay more in rent. But if wages aren't rising, you can't squeeze, more blood out of a turnip. And that's where the ceiling comes into place. I'm just looking at a couple articles. I mean, it says the U.S. just had its best quarter for wage growth in 20 years, especially for white people. The first 3 months of 2021 were the best quarter for wage growth since at least 2001. And then his wages have part of that is wage growth just was so lackluster over the past decade or two.
Yeah.
And so, but when we say it increased by 3%.
Yeah. So, but that
20% rent
news,
increase.
Though.
Yeah. It is news. But my point is that we need to see some wage growth. Given you get paid a little bit more. But again, let's say on this theme of like the theme of today is like, okay, let's make the crystal ball. We don't have a crystal ball, but like, what can we do to put one together?
Yeah.
When the minimum anyone is willing to work is $15 is the minimum, when before it was like $10, $7, $8, $9, $10. And I see every business is hiring, and I see FedEx hiring at 21 is the entry level position, $21 an hour. And then you can, at other places nearby, entry level positions like 25, 30. Again, those are $10 positions last year. That's way more than 3% increase, and we're not absorbing. And I wonder if just people just aren't taking those jobs yet. And so are those wages going to rise anymore because people just are deciding, I'm not working. You're seeing nurses walk off the job. You're seeing fast food employees, service workers. I mean, how many cases? Again, anecdotes, but how many times have we seen? It's like I'm seeing these videos, people being like, "We're not working." Like there's signs like fast food of like, "Sorry, no one came in. No one came in today. Everyone else quit. I'm probably quitting too. Like, have a nice day. Sorry." Or someone saying, like, pulling a Taco Bell, and the person's like, "I'm training, but the person that I'm supposed to be training me quit. I'm here by myself. I don't know how to work the cash register." Where you can order on the app, and I think we can get it figured out. Like, that's where we're at.
And that's a good point. And I did mention, like I said, I didn't, I don't have the numbers on wage increases, but I think that they seem like they're on the horizon. We don't have a labor shortage as much as a labor shortage for the pay rate. That's how to resolve a labor shortage, and that's a very big, complicated problem. That you can't just snap your fingers and change it. That takes a business plan, a completely different way of operating, maybe to kind of adjust labor costs. But if you're, for example, like in the construction industry, which has a serious labor shortage, that that could be a real place where, increased wages could really make a dent in it. Although we, like I said, haven't really seen a specific.
Okay, well, so I've got some more data. U.S. Bureau of Economic Analysis, wages in the United States increased 10.1% in July of 2021.
Wow.
Over the same month of the previous year, so year over year, 10%. So that's about what rents nationally have risen as well. Yeah. So again, coming back to and that makes sense, because I mean, who's hiring at $7.25 anymore?
Well, labor shortage and it's a recovering economy. So hopefully, we want wages to also grow because the economy's growing, because people are doing better than they did last year too. So that's another.
Yep. And again, coming back to reading the Fed's playbook, they want nothing more to maximize unemployment, or maximize employment and get wages moving, but not too much.
Totally.
they're we want wages to just grow, but not grow that. No, we want them to grow to here, because then we then inflation starts spiraling. But we are seeing wage growth, so that does justify some of the rent growth. And again, we're how does this market make sense? It seems crazy. How do you justify these prices? And again, like talking about a property in a market where the rents are growing 20% and there's no new supply coming on, and it's 98, the building's 100% occupied and the whole market's 98% occupied, you can wrap your head around starting to pay for that future income, because rents are going to increase. You want to try to buy off actuals as much as possible, but again, as we've mentioned before, if you're not, investing is the business of speculating. And if you're not taking any risk, you're not getting any return. If you only go to the absolute safest bets and sure thing, that's why bonds exist. And you're actually losing money on most bonds today, because you're taking less risk than there's more risk. And maybe it's holding dollars is riskier than anything else. But it starts to make sense when you start putting all the numbers together. That's what we're doing here on the Gray Report newsletter and the videos and grayreport.com, trying to make sense of it with everybody in real time, tracking this, because it's what we do every single day, focus on the multifamily industry, then doing this to make sure we've got all the best information to make the best decisions. And this is not a time or an exercise in pumping up investing in apartments. Like that is the business that we're in. But this is also, you've heard us talk about, downside of whether it's, rent control, other government intervention, or rising interest rates, if there was like a lot of storm clouds to talk about, that's what we would focus on. I've even had people say like, why, I'm surprised you guys were talking about that, because it's maybe not like as like, pushing people to invest in multifamily. we don't want to push anybody to do anything. What we're trying to do is create a clear picture, and maybe it'll help you understand why we do the things that we do and the choices that we've made and why we invest in the things that we invest in.
Yeah.
And if you want to participate with us and you think similarly than we do, we have opportunities. You can do that, and you can hop over to graycapitalllc.com to learn more. But none of this is actual financial advice, legal advice. It's all just, for fun and for educational purposes only. So, Matt, this is another great episode of the Gray Report News. It was really great. Again, just packed full of great information. But again, so I have to get back to this. The question has been asked, Matt, how do you do this? How do you put all this information together? Like, how do you put together the newsletter? How do you put we got the Gray Report website, we got these videos. It's a full, media platform. How are you able to put all this together?
It is a lot has to be a lot of thanks I have for a lot of these organizations like Berkadia, like RealPage, and Marcus and Millichap. All of these, there are a lot of reports that come out very regularly, and it's worth investors reading them. I'm just going to bring them to you because they are really valuable and they're worth following. I work, we provide this newsletter free for everyone, just as RealPage and Berkadia shares a lot of their, and Marcus Millichap and all of these large organizations. They're promoting their expertise. We're promoting our expertise, and we just want to share this information so that everyone can make the best decisions. And it's a product of the industry.
You're not giving too many secrets away, Matt. You're not.
I have my
talking
talking points.
Yeah. Okay, that's all right. Okay. All right. Thanks for watching. Subscribe to this channel. If you're not subscribed, subscribe now. Hit the button. That way you'll get an alert when the next one of these pops up. So we're not going to be spamming you. Hop on over to grayreport.com. That's how you can stay up to date every single day. Make sure you sign up for the Gray Report newsletter. You can find that. You can find it on the grayreport.com, but you can also find it at graycapitalllc.com/newsletter. And again, sign up for the newsletter. And then if you kind of like the emails you kind of started getting from us, including the newsletter, then you might decide, I want to take the next step and actually learn about investing in multifamily apartments. We're not dedicated to holding your hand and educating you. There's a lot of great material. Happy to point you to a number of directions, but we do have educational resources. That's just not our focus. But we have an investment club. You get, kind of first look at some awesome investment opportunities that we provide by Gray Capital. And then again, those are focused on multifamily acquisitions. We're investing in these deals ourselves, and then we invite some of our partners of our investment club to join us for the ride. So hop on over, check that out. Thanks again, Matt. Great episode. Come around for next week of the Gray Report, where we're going to be doing the exact same thing, even better. Okay.
Yes.
There we go. Okay. Thanks, Matt.